Welcome to our CFP exam prep discussion on gross income exclusions. Today we're diving deep into a critical tax topic that frequently appears on the exam. Understanding what's excluded from gross income can make or break your performance on tax-related questions. Let's start with the fundamental concept. While the IRS generally wants to tax all income, certain items are specifically excluded from gross income by law. The four major categories we're focusing on are gifts, inheritances, life insurance proceeds, and qualified employee benefits. Gifts often trip up test takers because they confuse who pays the tax. Remember this key point. The recipient of a gift never pays tax on the received amount. The tax burden falls on the giver through gift tax rules when the amount exceeds the annual exclusion. For 2023, that annual exclusion is $17,000 per person per year. Many candidates make the mistake of thinking small gifts are taxable to the receiver. Moving to inheritances, the principle is similar. Inherited property is not taxable income to the beneficiary. The estate may owe estate tax, but the beneficiary receives the property tax-free. A common exam trap involves asking about the tax implications of selling inherited property. Here's where the stepped-up basis rule comes into play. The beneficiary's basis becomes the fair market value at the date of death. Life insurance proceeds deserve special attention. When paid due to death, they're generally tax-free to the beneficiary. However, watch for questions involving the transfer for value rule. If a life insurance policy is sold or transferred for valuable consideration, the proceeds may become partially taxable. The exam loves testing exceptions to this rule, particularly transfers to partners or corporations. Employee benefits represent the most complex category. Certain benefits like health insurance, group term life insurance up to $50,000, and qualified transportation benefits are tax-free. A frequent exam scenario tests disability insurance. Remember that if the employer pays the premiums, the benefits are taxable. If the employee pays with after-tax dollars, the benefits are tax-free. Here's a practical example that often appears on the exam. An employee receives a $1,000 monthly transit pass from their employer, a health insurance policy worth $800 per month, and a group term life insurance policy with a death benefit of $45,000. All these benefits would be tax-free under the current rules. However, if the life insurance death benefit were $55,000, the cost of coverage for the excess $5,000 would be taxable income to the employee. The most common mistakes students make involve mixing up who bears the tax burden, misapplying the transfer for value rule, and failing to recognize when employee benefits cross the threshold from tax-free to taxable. Another frequent error is assuming all death benefits are tax-free without considering the type of insurance or ownership transfers. To solidify these concepts, think of exclusions as a protective bubble around certain types of income. The bubble stays intact unless specific rules are broken. Your job is to identify when those rules come into play. Look for keywords in exam questions like transfer, consideration, employer paid, or excess benefits. These often signal that an exception to the general exclusion rules might apply. Remember, the CFP exam isn't just testing your memory of these rules. It's testing your ability to apply them in complex scenarios. Focus on understanding the underlying principles rather than memorizing lists of exclusions.